Hello, everyone, and welcome to BFW 2401, Week 6, Liquidity and Liability Management, and this is part 2. And this part, as I mentioned before, we will talk about the measurement. Now, when we talk about the measurements, we are talking about these 6 types. So the first type is actually the net liquidity statements, and in the net liquidity statements, we are talking about the source. We just predict the source and the uses of liquidity, and according to that, we will determine on the sources and the uses, and then we will have something like the net liquidity requirements. So this is what we call it, net liquidity statement, and I will explain it. Now I have numbered those 6 measures here. And also when I cross-reference these numbers, I cross it to the slides that I will explain. The second part is the big group. This is just, we take 2 ratios, which is borrowed fund over total assets and loan commitments over total assets. And we compare it to our peers in the industry and see how we are doing in this on this front. Now, number 3 is the liquidity index, actually. The liquidity index is one that has calculation. So number 1, there is the calculation a little bit, but here we actually come with this index, and then this index, it measures how liquid I am if I'm going to sell my assets. If I'm going to liquidate my cash assets now, like securities and loans, how much I'm going to get. Of course, if I'm liquidated with a higher price, that will be better, which means it measures how liquid the assets I'm holding. And there is some calculation about this, and we will use this formula. Number 4, we use something called financing gap. And the financing gap basically is the difference between the loans we are expected to give and the deposit that we are expecting to receive in the future. And we see what's the difference. We add to that requirement the holding of the what we call the cash. We have to have a liquid assets and cash, and this has to be involved in the financing requirements. So we have to calculate the financing gap, add to it this liquid assets, and that will represent the total amounts we need. So the difference between the deposits and the loans plus the cash we need. And number 5, we talk about the BIS approach. BIS stands for Bank of International Settlement. I think we have talked about this bank. This is a regulator, belongs to Basel, within the Basel Committee. This actually, they have their own approach and asking financial institutions to look at it, which is they use something called the maturity ladders, which is they divide the timing of the cash incoming and the cash outcoming, and they will ask banks to see, okay, if the difference between the two, the difference between the cash inflow and the outflow, say 10%. What if there is some more stress and cash incoming is more or less than what you expected, and it becomes now the difference is 20%. What about if it is more or less, say 30%? You will put some scenarios and they will test if these scenarios happen, how you are going to manage. Do you have really the sources to borrow or from your asset to sell to deal with this issue? This is what the BIS approach looks for. And they don't have any calculation for you in this one. Number 6 is actually the liquidity planning, and the liquidity planning look for the whole picture. So they want you to model under a normal cases, under season, under different economic cycles, under contingencies, and you will come up with this whole package and then see what will be your liquidity requirements under all those type of circumstances. So having said that, let me go to number 1. Number 1 is, as I told you, you can reference, as I told you, this is number 1, which means in this slide, it's number 1. So the source is actually the sale of liquid assets with minimum price risk. you can borrow, this is another source, or can use the reserves, like the central bank, whatever. The expected uses, you can, uses include borrowed or money. Then you have the market funds already utilized. This is actually part of the uses, but here it's clear picture here. So this is actually this all the sources, which means maturing assets, people who are going to pay us their loans, or when we receive our bonds and other securities, when we have, this is all either investments or loans. This is the sellable. This is when we sell our, what we call a sellable, means when you sell your assets, if you decide to sell them, how much they will give you. And then you have to, access to deposit liabilities, whether you can actually take deposits, the deposits, actually the deposit that will be deposited in your account, either from retail depositors or from the interbank, from other banks you can have. And then whether you can have established credit lines, which means if you have, withdrawal lines with others, this is actually sources. And whether you can sell actually your loans, either through loan sales or securitization. So all of this, either the maturing asset or selling them before maturity, the deposits represent another source of cash coming, and whether other people can borrowing you, giving you all this borrowing, or whether you can sell your assets. So this is the 5 main sources. Now, the interesting thing is you can do it for 1 day, 1 month, and 6 months. You can do this in daily basis. You can do it on monthly basis, quarterly basis, or even semi-annually cases. So in this case, if you use 1 day, the total resource 54. And the total uses is the liabilities falling due, which means people who are going to receive their liabilities. Some of them, like the CDs, the commercial papers, the bonds you are issuing, those are actually type of liabilities that you have to pay. And whether you have, you have engaged in some type of commitment that you will pay to your customers, like loan commitments, or giving them any type of line of credit from your bank to your customers. This is your expectations, how much it will be. And then other cash flow from unanticipated events. You have to anticipate this. We just anticipated here 4. So if you add the sources minus the liabilities, the uses, you have 4. This is how the statement looks in 1 day. In 1 month, it will look like this, just same thing with different numbers. However, the thing that maybe I change is this one, the 4 here, you are assuming this is the last, if we are talking about month, this is the last day of last month, and this is the first day of the month. So if you look at this month, for example, if this is January and this is February, this is actually the last day of January. You bring it here. This is like a cash budget. If you have studied, corporate finance, or have been to this class, or you're going to take it, we have something called cash budget, which show you, cash coming and cash, leaving. But this is based on the bank operations and the sources and the uses in the bank. So we have here uses of 750, and we have sources of 750, uses of 800. The difference is 50, and then because we are talking about cumulative, not single month or single day, we are talking about cumulative. So it's 46, which means you have 50, you have 4 surplus here, 50 deficit here, it's 46. If this is, for example, if you are doing it on a monthly basis, and this is the 5th month, and this is actually the last one, you can calculate it even for 6 months, month 1, month 2, month 3, and you can see in the 6 months, how does it look by the end of 6 months. So of course, here we will take the 5th month. Here will be the 5th month, 46. And then you have the sources of 8650, uses 7,500, 104, which is 1150. You can look, so with the cumulative over 1 day is 4, for 1 month, 46. For 6 months, if you take it all this time, it will be 1104. But of course, we will do the liquidity, if you are going to do it monthly, of course, you have to do it daily, and then you accumulate it to monthly, and then you can make it 6 months or 1 year. Depends, because maybe you want to see what will be your requirement in the 1st month, in the 2nd month, or after 6 months. So in this case, if you know the surplus or the deficit, in this case, you can either invest it if it is too much money, or either you have to arrange for borrowing from now, not to wait until that moment. Now, this is another look at the net liquidity positions, but this depends on a period you take. This in this period, for example, they take total cash type assets. They take how much they can borrow. This is how much they can sell from their assets. This is how can they take from the central bank. So it's 14,500. This is just another example. Then the uses of liquidity, it will be interbank funds borrowed. And this is the Reserve Bank rediscounting, which is 1,000. This is the repos. This is when you repurchase your assets that you have sold to the central bank in this particular area. This is actually a net liquidity statement with the central bank. So this is 7,500, which is the difference. But this is, if there is an example in the exam or in the tutorial or in the test, so it will be, you will be provided by this information and you have to calculate it. So either this information or this information, and then you have to know what is the uses and what is the sources. Big group, as I told you, we have only, you can calculate these two ratios and compare it to the group, to the industry peers, and see how you are doing. This is the liquidity. This has been in the test for many times, liquidity index. Now, what I want to tell you about liquidity index, this example is saying, this is the formula, but don't worry about this formula. It's called, it looks a little bit like, econometrics or something. No, it's a very normal thing. It's just you take the weight. This is the total, all the assets from 1 to n, all the asset weights, and then you take the BI. BI is actually the the selling or the liquidating price, and this is the selling and maturity. So I have two assets that I will liquidate today, or I can wait for 1 month, because this one of them is actually government securities, and they are 40% of my portfolio, and the rest is loan, which is 60%. Now, if I liquidate this in 1 month time, which is the time when it is matured, it will give me 98. And if I liquidate it today and I don't wait until next month, it will give me $98 per each 100. For the loans, if I liquidate it in the same time with the treasuries, this is actually close to maturity after 1 month. So for each $80 that has a face value of 100 when it really completely mature, if I liquidate it in 1 month like this one, because I'm measuring next month, it will be 82, it will be 93. This 93, which means you liquidate close to maturity. So if you take this, if this is actually now the BI star, and this is the BI star. This is the BI star, and this is the BI star, and this is the B, and this is the P. Okay, you just calculate. The weight is for 40% for the government securities, 60% for the loans. And this is 98 for over 100, just the PI over the PI star. And this is 82 over 93, we get 92%. 92% mean if I liquidate, it will be 92% of my total assets. Of course, I want this, if I'm very liquid, this will be 95, 97, even 99. But this is what I will get if I decide to sell my assets today. Now, this also has been in the test for some times. This is actually very easy because you will have assets and you will have liabilities. This is what we expect to receive, how many loans we are going to give for the period that we are planning. And this is how many deposits we are going to receive. So actually I'm in shortage because I need to give loan for 25, I'm going to receive 20. So the difference is 5. And therefore, this is what we call it the financing gap. Now the financing gap is actually the liquid assets the liquid assets. The financing gap is the actually the loans minus the deposits. This is the financing gap. Please correct it on your side. So it's loans minus deposits, which is this one minus this one. But now when I want to, this is the financing gap. Now when I want to finance, when I want the financing requirements, I will have some type of assets, some type of liquid assets. So actually I need to add to the financing gap my liquid assets. So my financing requirements now, which is a new term, which I need to borrow, will cover the financing gap, which is the difference between the two, plus the liquid assets I wish to hold because I need to have liquid assets. And therefore, this will be actually 30 because if the liquid asset is 5 and the difference, if the liquid, will be 10 actually. The liquid asset is 5 and the difference, which is the financing gap, is 5. So this is what I need to borrow. So the financing requirements, as you can see, is actually 10. So let me just summarize it. Now the financing gap is the financing requirements equal the financing gap and the liquid assets, and the financing gap is actually the loans minus the deposits. It's very straightforward, and I think this is the financing gap. Okay, let's go to this is the BIS. BIS, there is no calculation. It's a maturity leaders. So for each maturity, maybe you take 1 to 30 days, maybe you take 1 to 3 months, maybe, for each maturity, you have to assess, depends on how maturities you have. You can have it on 1 to 3 months, 3 months to 6 months, 6 months to 1 year, 1 year to 2 years. It's up to you. I mean, it depends on the gaps on the ladder. So it's some maturities like what we have seen in the interest rate, but here for liquidity. So you will, assess all cash inflows versus the outflows. And we know what is the inflows that is coming, like from depositors, and outflows like loans we should pay. So we have to do it daily. We can do it in daily and cumulative net funding. It can be determined in this manner. So you can do it in horizons, and also you can do it in daily basis. It depends on the horizons and the ladder you are using. It must also evaluate. This is the most important thing about this approach. is the what if. And the what if means you have to have different scenarios. So if you assume here the asset inflows is coming from depositors 20, and this is 30 or 25, so the difference is 5. What if this is decreased by 10% and this increased by 10%? So you come up with different scenarios, and these scenarios, of course, you have to be very aware when you develop those scenarios. And then in this case, you will see what is the difference. Now, when you see the difference, which is the financing requirement and liquidity requirement, then in this case, you will test your ability to raise that type of fund in that time. If you fail, and this is what central banks are asking from, the financial institutions under their jurisdictions. If they fail in addressing that, what we call, the scenario, or they call it liquidity stress testing, then there will be some type of shortcomings in the financial institution. So he has to show, or the bank has to show, what he's going to do under different scenarios. There is more information here if you want to see about the stress testing. As far as this class concerned, I just want you to know that there is a ladder, and this ladder is actually, using different scenario analysis. They take the cash outflow, and then they take it under different, sensitivity analysis. Now, liquidity planning, as I told you, we have to take all these issues to put the picture, which is the immediate liquidity obligations, which is the normal thing of the cash inflow and outflow. And what about if there is a seasons? What about if there is holidays? What about if there is, occasions, like Chinese New Year, Eid al-Fitr, Christmas, Deepavali, all those time, weekends even, we have, but the season is actually about those, that coming in seasons. So you have to take that to considerations. You have also to see the behavior in terms of trends. How does it grow? And you have to look also to the economy, the cycle of the economy. Of course, in booming time and inflation time, usually there will be mass withdrawals. And in depression and slow economy, it will be different type of saving behavior and withdrawal behavior, which is deposit additions and deposit withdrawals. And we have contingent liquidity needs, and this is the most difficult thing actually to predict. This is a summary of what I just said here. It just, when we say here the seasonal, it can, as I told you, can be predicted or cannot be predicted sometimes. Like when we talk about the influence of large borrowers and large depositors, these people can, cannot actually predict their, withdrawal behavior. Trend liquidity is just predicted over long term of time, likely to be associated with, the depository institution, particular customer base. Are you living in fully, if your customer depends on, for example, 90% of customers is, for example, from Chinese race, then in this case, you expect Chinese New Year to be high withdrawals. If you are living in areas where there is two other, races, then they have their own celebrations, and depends on your customer base. So it depends on the customer base and their withdrawals. This has to have some analysis. It has nothing to do with race. It has to do with liquidity behavior. Liquidity planning, as I told you, it can be cycle and it can be contingent. When we talk about cycle, it's the business cycle, as I told you, booming and depression. And it's also difficult to predict because we don't know how the economy is going to behave. Whether COVID is coming, whether we have another COVID coming, or is it the end? Whether we have some other, financial crisis coming or market crash coming, or we don't know. It's actually, it needs too much, analysis to do. And then the contingent even more difficult, and liquidity needs necessary to meet an unforeseen events. Basically impossible to predict this type. So EPRA, for example, which is the central bank in Australia, requires the institutions to hold sufficient liquid assets to meet specific institution or some type of crisis. I am done for this part. Thank you. And I will just stop it. And I will see you in the third part.